SIP stands for Systematic Investment Plan. It's a simple, disciplined way to invest regularly into mutual funds. You allocate a fixed amount of money at regular intervals, usually every month. The biggest advantage? You don't need to worry about market timing. You're investing a set amount, whether the market is up, down, or sideways. This approach reduces the emotional stress of market fluctuations. Think of SIP as planting a seed today that will eventually grow into a large tree. The seed represents your initial investment, and over time, it grows with consistent nurturing, your monthly contributions, and favorable conditions, like market performance. Over time, this small investment grows into significant wealth. Key points. SIP is a long-term investment tool. Consistent investments help build a habit of saving. No need to time the market, which can be tricky even for experts. Let's now talk about how SIP actually works. When you start a SIP, you typically decide on three things: the amount you want to invest, which could be as little as 500 rupees or $10 per month, the mutual fund you wish to invest in. There are different types of mutual funds like equity, debt, or hybrid, and the frequency of your investment, usually monthly, but it could also be weekly or quarterly. Every time you invest, your fixed amount is used to buy units of the mutual fund based on its net asset value, or NAV, which is the price per unit. When the NAV is low, you end up buying more units. When the NAV is high, you buy fewer units. This process is called rupee cost averaging. Over time, this strategy smooths out the market's volatility, which can be beneficial when the market fluctuates. Key points. Regular investment intervals make investing easy and hassle-free. You buy more units when prices are low and fewer units when prices are high. Rupee cost averaging. Consistent investing reduces the risk of market timing. When you invest through SIP, your money is pooled together with contributions from many other investors. This pooled money is managed by a professional fund manager who invests it into a diversified portfolio of stocks, bonds, or a mix of both. What's great about this is that SIP gives you exposure to multiple sectors like IT, healthcare, manufacturing, and more. Instead of picking individual stocks, which can be risky, you're invested in a diversified portfolio that spreads the risk and gives you a better chance of earning returns. Key points. SIP investments are pooled with other investors' money. Professional fund managers invest the pooled money in a diversified portfolio. Diversification helps reduce risk and increases the potential for better returns. The real magic of SIP comes from the power of compounding. Here's how it works. When you earn returns on your investment, those returns are reinvested, which means you start earning returns on your returns. Over time, this snowball effect can lead to significant growth in your investment. Let's break it down with an example. If you invest 5,000 rupees every month for 20 years and your investment grows at an average rate of 12% annually, you could accumulate more than 50 lakhs. This is the power of compounding working in your favor. Key points. Compounding helps your investment grow faster over time. Returns generated on your investment are reinvested, creating a snowball effect. The earlier you start, the greater the impact of compounding. SIP also offers flexibility. You're in control of how much you want to invest and when. You can increase your SIP amount as your income grows, pause your SIP if you're facing financial difficulties. Withdraw money in case of emergencies, although it's always better to stay invested for the long term. This flexibility, combined with the discipline of regular investing, helps you build a robust financial habit that leads to wealth creation. By committing to a fixed amount every month, you're making saving and investing a priority in your financial life. If you're new to investing, SIP is the perfect way to start. Here's why. It's simple and automated. Once you set it up, the process runs smoothly without needing constant attention. You don't need a large sum of money to get started, just 500 rupees or $10 a month. It reduces risk by averaging out market volatility over time. It builds a habit of disciplined investing, helping you develop a long-term financial strategy. The earlier you start your SIP, the more time your money has to grow through the power of compounding. So don't wait. Start investing with SIP today. One of the major benefits of SIP is what we call rupee cost averaging. Sounds complicated, right? But it's really simple. Here's the deal. When the market goes down, the same fixed amount you invest buys you more units. And when the market is up, it buys fewer units. Over time, this averages out the cost of your investments and minimizes the impact of market volatility. This strategy allows you to avoid the stress of trying to time the market. Whether the market is high or low, you're consistently investing. And this is where SIP truly shines. It keeps you disciplined and helps you navigate the market's ups and downs with ease. Did you know SIP can also help you save on taxes? That's right. If you invest in equity-linked savings schemes, ELSS, through SIP, you can avail of tax deductions under Section 80C of the Indian Income Tax Act. You can claim up to 1.5 lakhs in a financial year, reducing your taxable income. So not only are you growing your wealth through SIP, but you're also optimizing your taxes. This makes SIP even more appealing for salaried individuals or anyone looking to reduce their tax liability. When starting a SIP, one key decision is the investment horizon. Should you go long-term or short-term? Long-term SIPs are ideal for wealth creation. The longer you stay invested, the more you benefit from compounding and market growth. It's best to think of SIP as a marathon, not a sprint. Short-term SIPs might suit your needs if you have specific short-term goals, like saving for a vacation or a down payment on a car. But remember, the real magic of SIP happens over the long haul.